Hello everyone, this is Rob McDougall from Zhang Financial here with your weekly economic update. Today is Monday, December 22nd, 2025. As we mentioned in the last several weeks, the logjam of economic data has been unleashed. So we are getting new economic data, but it's kind of all over the board. Some are October, some are November, some are October and November. Some just skip October and go straight to November. But a lot of economic activity reported last week, and sort of the takeaway kind of mixed to negative, which sounds horrible, except for the fact that it all leads to the fact that it is more likely than not we'll get at least one more Fed cut next year, probably two, and we'll look at those probabilities. So some of the economic data released last week, starting on Tuesday, was non-farm payrolls. Now this one's super important, labor market, hyper-focused by investors. And it is not a clear picture at all. So the month of October was released, and the actual was negative 105,000, which doesn't really kind of seem to make sense. And the November number on the same day was released, so positive 64. Now, I will mention that during the last FOMC meeting, at the end of it, Chairman Powell mentioned that the labor market number from the BLS had a systematic bias of overshooting by 600,000. So I'm not sure if they're making an adjustment for October or not. I guess some of the speculation is the fact that the delayed workforce reductions in DC, individuals that were offered early retirement packages, many of them happened in September, October. So it's possible these numbers are correct, but I don't have any confidence in them. So retail sales for the month of October, not November, for the month of October, came in retail sales month over month a little lighter than expected. I was expected to be up 0.1%. It was flat, although retail sales ex-auto was expected to come in at 0.3, and it came in a little better at 0.4. So I guess between those two, kind of a push. Unemployment rate, though, this definitely was a tick up in negative. It had been 4.4%, but I think that was 2 months ago. For the month of November, unemployment rate at 4.6%. The participation rate was higher, but nonetheless, all we've talked about for months, labor market weakening, probably that 4.6 and the deterioration from 2 months ago, that's probably accurate. Also on Tuesday, it's a huge day from economic data. Average hourly earnings rate was released. This is for November. The expectation was a positive 0.3% month over month, and that was a little disappointing. Came in at a positive 0.1%. The big number last week by far, inflation. Everyone's focused on that because inflation, whatever happens with inflation, really dictates pretty much what the Federal Reserve will do with short-term interest rates in early 2026. Inflation rate was actually much better than expected. And this really surprised people. And again, the quality of this information is suspect. We just really don't know. We've had so much disruption in the government process of collecting data and reporting it, so we don't know. But the core inflation rate, or just the headline number, was expected to come in November at 3.1% year over year, but it came in at 2.7%. And the core number, also equally impressive, was expected to come in at 3.0%, came in at 2.6% year over year. So that is really good news for investors just in total. Federal Reserve, it certainly allows them to, as part of their argument, to cut rates early next year. Also on Thursday, initial jobless claims that had the week before came in at 224. The consensus was 225, and it came in at 224. So no real news there. Existing home sales on Friday, which certainly doesn't move the market, but for those of you interested in housing, existing home sales was expected for November to be 4.2 million, came in a little light, 4.134 million. Now, the third quarter GDP numbers haven't been printed. We'll give you that number in just a moment. But the Fed's estimate, they brought theirs down a little bit more. The Atlanta Federal Reserve, at one point, they were up over 4%, their expectation for third quarter GDP. growth, and now they brought that number down to 3.5%. And at the same time, economists have been bringing their numbers up. So they're triangulating. It looks like 3.5 might be a good guess in terms of GDP growth for third quarter. In the inflation expectation, the 10-year break even, it's got a nice downward trend here over the last several months and at a very low 2.24% average expected inflation over the next 10 years. Fed funds rate. So in terms of cuts, January, FOMC meeting in January, only 20% probability of a cut is built into the futures market. But then if we look to the end of next year, December, the odds of only having one additional cut, so we're definitely, per the data, getting one cut at least, but that's only 5% probability that we only get one. We have 75% probability built into the futures market that we'll get at least two, and we have 43% odds built into the futures market that we'll get at least three cuts next year. So let's take a look at how the markets did last week in terms of U.S. equity markets. Despite the fact that was pretty consequential economic news, there really wasn't much movement. S&P 500 was up 3 basis points. NASDAQ was up almost 0.5%, but no real movement. So at the end of the week, we had the S&P 500 on a year-to-date basis up 17.5%. If we look at the developed markets ex-US for that same time frame, they're up 30.45%. Emerging markets up just a little over 30%. Last week, developed markets ex-US up slightly, 25 basis points. Although emerging markets were down last week, it was a negative 1.32%. Fixed income, another solid week, and it's been a fantastic year. So the 2-year, the 10-year, both down 4 basis points during the week. That led the Bloomberg U.S. Aggregate, easy for me to say, U.S. Aggregate Bond Index up 34 basis points last week. So for the full year to date through the end of Friday, that index is up over 7% for fixed income. Pretty stellar. This week, economic activity. So plenty of stuff to talk about a couple things to talk about despite the fact that it is a holiday shortened week. Durable goods orders that will hit tomorrow. That is expected to be down. It's for the month of October, so not sure how much impact this will be, but durable goods orders month over month expected to be down 1.5% for October. For the month of September, that was up. It was a positive 0.5%. The big one, the only one that probably matters this week, that GDP growth number for the third quarter. The expectation is 3.2%. That's a consensus. As we mentioned, Atlanta Federal Reserve thinks it's 3.5. Blue chip economists have been moving their number up, so they're closer to that 3.2. So we'll see. We'll get that tomorrow. And for the second quarter, you may recall, was a positive 3.8%. Then on Wednesday, we do get initial jobless claims. The expectation is it hardly moved. Prior week, again, was 224,000. It's expected to come in at 223,000. Well, that's it. That's a wrap for our weekly economic update. We thank you so much for attending, and we'll look forward to seeing you next week. And Merry Christmas. Thank you.